right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack. Honored to be with you today, where we are continuing our conversation now into the 6th episode of the 7 deadly tax traps that entrepreneurs often fall into. So far, we've covered entity structuring, we've covered do-it-yourself taxes, we've covered a bit on real estate depreciation. We have talked about brokerage accounts and the challenges that come with those and how some people turn to the brokerage account and away from a retirement account. And we started this entire conversation with the topic of tax environments and capital gains versus ordinary income versus dividends versus rental income. Today, we're going to be talking about the use of insurance. And I've covered this on standalone topics, but I think it's important for this conversation because there comes a point in the life of the business owner and the real estate investor where you are no longer eligible for some of these tax advantaged accounts like the Roth IRA, right? The Roth IRA is one, subject to contribution limits, and 2, subject to income limits. So if you're making a certain amount of money in the $300,000 or $400,000 range, then you are not going to be able to contribute the max amount to these accounts. And therefore, many people consider themselves without the hope of such a thing, and they have to turn to either brokerage accounts or tax deferred accounts in these higher income years. But today we're going to be talking about the use of life insurance as a supplement to your retirement plan. And again, I've done episodes, we've had experts on to talk about this. One of our top podcasts ever made with David McKnight, who is the author of Tax-Free Wealth, which is a book that I highly recommend. And also I would highly recommend you listen to that podcast. I'll cover bits and pieces of it in here, but we go into depth on the topic, many things that people get wrong, some of the things that people get right, how we should be looking to these insurance vehicles for wealth creation, tax savings, retirement planning. But I want you to know from the start that life insurance isn't just for death. It's not just about protecting your life. That is the primary use. But the wealthy and those who are aware of the benefits use it to live better and tap into tax-free equity through the use of life insurance. So, like I said, you get to a certain point where some of the tax benefits that the government sets up for you are no longer working in your favor. Accounts like Roth IRAs were initially started for the middle and lower classes to be incentivized to put some money away while not having the future threat of taxes hanging over their head. So again, another podcast episode we did with Ted Benna, the creator of the 401k. He goes into the details of these retirement accounts and the way that they created these retirement accounts to benefit the user of these retirement accounts. And the Roth account specifically was created for the lower income wage earner who might be putting retirement to the side because they have so many needs that they need to meet in the present moment that they can't think about putting money into a tax deferred account, which they'll have to end up paying taxes on in the future. And so what the government did and the regulators did and what eventually made its way into our tax code was that we set up these Roth accounts to say, okay, you can contribute to this account, continue to meet your needs, but when you contribute to this account and when you invest that account and you reach a certain age, you're not going to have to pay taxes on the end result, on your withdrawals. And so that obviously incentivizes more people to put the money away because they know that not only will they not be taxed on it in the future, but they can grow it and not pay taxes on it. So these were set up to help the lower and middle class wage earner plan for retirement. The government, when it's working in its right form, is there to reward good and punish evil. Now, power corrupts, and we don't necessarily see that all the time. And because of our fallen world, justice is not a guarantee. But working from a biblical perspective, we are told in the book of Romans, Paul wrote a letter to the Roman church of that day to subject yourself to the rulers because they are put in positions by God to reward good and punish evil. And so what the Roth account is doing is it's rewarding a good act. It's rewarding the efforts of the wage earner and the taxpayer to put money aside, to save for the future, to plan for the future, which in itself is good. And again, the Bible talks a lot about saving for the future. That being said, it makes sense why there would be contribution limits and phase out restrictions on such accounts. Because if it's for a certain individual who's not making a certain amount of money, then you're going to phase it out and put limits on those contributions. We work with a lot of entrepreneurs, business owners, real estate investors who want the promise of tax-free retirement, but they're very discouraged because they know that the Roth is subject to income limitations. They're aware of the Roth, they like the idea of a Roth, but they know that they can't invest in a Roth because of these limitations. So what are they to do? It's not that they lack all sorts of opportunity, it's that they lack the right knowledge and the application of that knowledge. Cash value life insurance can offer a lot of the same benefits as a Roth while also guaranteeing a future inheritance or legacy for your loved ones, and it gives the higher income earners a taste of the tax-free pie. Again, check out our podcast with David McKnight. Let me unpack that a little bit. It guarantees an inheritance or a legacy for your loved ones. So permanent life insurance, which is cash value life insurance, whole life, indexed universal life, variable universal life. These are all life insurance policies that their primary purpose is to insure your life. I will never tell you that a life insurance policy's primary purpose is to invest. The primary purpose is life insurance. It is a life insurance product. That being said, it doesn't mean that you can't use it to invest or to build wealth. But the primary purpose is to ensure that your beneficiaries, those who come after you, are taken care of in the event that you pass on. And it's permanent. So I say guarantees because so long as you're paying your premiums, this is not like term in the fact that it expires after 20 or 30 years. It's permanent in the fact that as long as you're paying your premiums, when you pass on, your beneficiaries will receive the death benefit. Most people, however, overlook insurance because they think it's only for protection. But the internal cash value in the right policy becomes a personal tax-free bank over time. Again, these written about and people far smarter than me and far more in the weeds of this topic than me have done their part in educating us. Tax-Free Wealth is a great book by David McKnight. Become Your Own Banker is a great book on whole life and the idea of infinite banking that continues to be a topic of conversation in the financial space. But those are two great resources that I will point you to go a little bit further in depth on this topic. Key point number one, all of these are permanent in nature and will last longer than the 20-year period that I have for my term insurance. The differences between term and permanent and the use of cash value to build a tax-free nest egg for you, especially those who are making a certain amount of money that are phased out or excluded from contributing to a Roth. So as I mentioned, term insurance has a term to the time period that you can actually receive a death benefit. So I have a term insurance policy. I believe it's a 20-year policy that I took out when I was 25. So by the time I'm 45, if I am still alive, those premiums that I was paying towards the term insurance policy, I will no longer pay after the term expires, but the death benefit is no longer available for me either. And so it can almost feel like that money is now lost. Now, we have peace of mind that if something does happen to me between the time that I first purchased the policy until it's expired, that my family will be covered. So I wouldn't say that's a waste, but if I get to the 20 or 30 year time period, it can very easily feel like a waste. Now, permanent insurance is different in that so long as you're paying the premiums, your life is insured. So you can be 80 years old and have a $1 million death benefit because you have permanent cash value life insurance. You have a whole life policy. You have an indexed universal life policy. You have a variable universal life policy. Key point number two is that they are referred to often as cash value life insurance, which means that you can develop a cash value in these policies. So if you pay more than your premium amount to this insurance policy, what you begin to develop is a cash value in this insurance policy. And that cash value, depending on the type of insurance policy that you are contributing to, is either invested in the markets if it's indexed universal or variable universal life, or receiving dividends if it's whole life. And that dividend rate can vary depending on the type of policy and the company that you are using it for, but you can contribute over the premium amount to develop this cash value amount. And so what then happens is that it's either invested in the markets or it is receiving dividends, and it starts to compound and accumulate. And so you have this cash value that's growing, and it can be tapped into a bank account of a certain form. The difference is that rather than just withdrawing the cash and being done with it, you can take out what's known as a policy loan, and it's a loan against the policy or a loan against the cash value. And so you can then take a loan out, receive $50,000 from your policy, either the death benefit or the cash value. And again, there's people that know more about this than I do, but it is a great benefit in the fact that if you get a policy loan, so you take a loan against the policy, that comes to you tax-free because debt is not taxed. And you can then go and invest that into different properties or businesses. And the idea is that you can then go and take the dividends that you receive or the rental income that you receive and pay back the loan plus any extra that you might receive as a result. And so it works in the form of a loan, except you're paying yourself back on the policy. So that's difference number one in the way that a loan works. But also, if you don't pay yourself back, it just decreases the death benefit that your family or your beneficiaries might receive. So say I have $1 million policy, I take a loan out for $50,000, it comes down to $950,000 death benefit. I don't pay any of that back. They don't get the full million, they get the $950,000 that is net the $50,000 loan, but they're still getting money. And if you use that $50,000 to invest into a property and you have your right trust and estate set up, then they're probably getting more than just that $950,000. So these policies can be used to accumulate tax-free growth because the cash value is tax-free and the policy loans that you receive are tax-free, which is a benefit to you because if you are going into this field because you don't have the ability to contribute to a Roth because your income limits are being met, then this is an option to kind of get the same result a different way. Now, things to look out for is that the premium is not going into your cash value. So you are still paying a premium to keep this policy together. You can't over contribute, otherwise you're going to, it's referred to as a MEC, MEC, basically says that if you contribute more than is allowed, there's tax consequences and the insurance policy can lapse, and there's a whole bunch of different downstream consequences that happen. And that's why getting the insurance provider involved and making sure you're aware of what that limit is and optimizing the policy so that you don't MEC out. Because the worst thing that could happen is that you over contribute and now the tax-free benefits that you thought you were receiving are no longer available because you didn't comply with the ordinary regulations. So this works for whole life, this works for indexed universal life, this works for variable universal life. Again, books and podcasts like the one that we did with David McKnight and his books Tax-Free Wealth, a book like Becoming Your Own Banker. We have a good friend, Caleb Williams, his company Better Wealth. They are specialized in this idea and they set up these policies for a lot of folks. I would point you towards those resources. And just like I am very adamant about hiring a professional to create a tax plan, I am adamant about finding the right professional to draw up a policy that works for you in this regard. While a big mistake is avoiding this cash value life insurance altogether, another mistake would be moving too quickly on it and not having the policy set up properly. Because if the policy isn't set up properly, you can limit yourself in the number of contributions, and you can also limit the way that you are able to withdraw from the policy, whether it's the cash value or the loans that you are available to receive. An added benefit to all of this would be the insurance itself. The death benefit gets paid out to your beneficiaries completely tax-free, because insurance is insurance, and the way that it is set up from a tax perspective, according to the tax code, benefits from insurance come to the beneficiary tax-free, so long as it is the fair value amount of what is being replaced. And when it comes to life insurance, the full amount of death benefit that your beneficiary receives is the fair value, because it's just the death benefit that's been tracked since the beginning of time. I say that because Some people will receive more than what they are giving up in the form of the home or the car. If they get a benefit from a car insurance policy or a home insurance policy and they get more than the fair market value of the home or the car in this instant, then that could have tax consequences. But you don't have to worry about that from a life insurance. All life insurance proceeds to the beneficiary are tax-free. So you get tax-free benefits in the form of the withdrawals from the cash value, tax-free benefits in the form of policy loans coming to you tax-free, and then your beneficiaries get tax-free benefits when you pass on, because again, it's permanent insurance. So if you're 90 years old and you go into the next life, then your beneficiary receives that $1 million death benefit completely tax-free. So there's multiple tax benefits to this. The biggest thing is that you are still going to be taxed on the amounts that you contribute or the premiums that you pay. You can't avoid, and that's a big part that doesn't always get talked about. So again, I want your best interest to be considered. Do not think that you're getting a tax deduction by investing, and I use that word lightly and don't quote me on that, but do not think that you're getting a deduction by paying a life insurance premium or over contributing. You are taxed on that just as you would be taxed on the amounts that you contribute to a Roth account. I say that and I emphasize that point because we have seen people come to us with books that show a $150,000 deduction for insurance. It's a life insurance policy and we have to add that back, and then they're taxed on that amount whether they knew it or not. So beware of that as well, but know that the tax benefits that come, as I lined out, with the policy loans, the cash value, and the benefit are substantial, and especially for those who are phased out of contributions to a Roth account, this can be a great way to tap into tax-free wealth, a retirement supplement, I'll call it, because it's not necessarily a retirement plan. You have to be cautious about the words that you're using, especially when you're putting stuff out on the internet. That being said, none of this is personal tax advice. This is for information purposes only, but I trust information is valuable to you. And if it is, please do us a favor and subscribe, give us a 5-star rating and review, and share it with a friend. We will be wrapping up our 7-part series next week, where we'll be talking about expenses that people often miss out on and how that can lead to severe tax costs. This one was all about insurance and how a lot of people avoid insurance for all the wrong reasons. Until next time, God bless you and keep moving forward.